and welcome to WION World is One. I'm Kanishka Sarkar, and today let's talk about how not just geopolitical disruptions but also tech disruptions are impacting markets and more specifically your wallets. Foreign investors are pulling out money out of India, India's market cap ranking is slipping, and many investors are asking the same question. When will money come back into Indian markets and into the common man's pocket? To get clarity on some of these concerns, I have with me market expert Mr. Ajay Bagga. Mr. Bagga, thank you for joining me on WION today. Let's start by talking about the FIIs. They've pulled out more money in 5 months this year than all of last year. How worried should the ordinary investor be at this point?
Well, we should be worried. That is a big problem for our markets. Our markets would be much higher, but for this continuous outflow. Overall, if you see, it is happening in quite a few markets. Even the Korean market, which is up nearly 100% this year, has seen outflows for the last 2 weeks. So some amount of money is going out of emerging markets. And that happens when the dollar is strong or when the expectation is of a interest rate hike by the Fed rather than a cut. Last year, the expectations were high that there would be a interest rate cut and emerging market flows should pick up. That did not go through. And again, this year we are facing the same issue. So it is a problem and we should be worried about it.
Right. But Mr. Bagga, if the Indian economy is still growing, GDP numbers are decent, why are foreign investors still choosing to leave?
See, there are two things to this. One, our earnings growth is not as strong as it used to be. So for the last 8 quarters, our earnings growth has been in single digits. Secondly, our valuation is very high. So our valuation of our stocks is as if we are still growing at 15, 18% earnings growth, while we have come down to about 5 to 8%. So that is the biggest issue. The second big thing that we have to keep in mind is that global capital has a lot of options, and India has a few negatives. One is we are very oil dependent. The high oil prices after the Iran war have caused some amount of disruption. Second, our rupee has depreciated. That's become a vicious circle. So more selling happens by FIs, more the rupee goes down. More the rupee goes down, more they sell further because their dollar returns are going down. That's the second issue with us. Third, we don't have pure play artificial intelligence IT players like, say, Korea, Taiwan, China, America has. So a lot of global money has been going there or in pure play commodity players. Again, we don't have that kind of a market. Fourth, what has happened is that some taxation changes over the years have made our market quite unattractive. This is one of the very few markets in the world where we tax foreign capital. Foreign portfolio is taxed. So that is causing some amount of angst. But even if we remove that on the margin, the other big things make India not such an attractive market for foreign investors.
Right. Couple of points that you highlighted, that one, India is dependent a lot on imported oil. Then there's the weaker rupee, no pure AI play. And then there's taxation, which has been a concern. Now, you were talking about the global capital, how it has options. India has slipped to the 7th place in global market cap rankings. Do you think it's a temporary setback or a bigger warning sign at this point?
It's temporary because, see, who has taken our place? Number 5 is Taiwan. There, the large part of the market is semiconductor, one company, TSMC, and then the other second company. So they are the large lion's share of the market. Same with the Korean market, if you see, is largely Samsung and SK Hynix, the two memory players. They have really outperformed and taken the market up. And on Friday, when there was some correction, some money pulling out of these AI momentum plays, we saw the Korean market fall at 1.6% down, and then it ended down 5%, which is not too bad because it's up about 225% over the last 2 years. So we are competing against much smaller economies, and very concentrated markets which have AI plays. When this AI momentum play works out, you will see these getting lower than India. We will catch up. We have the population, we have the scale of the economy, and we have a very well diversified stock market. We will overtake them eventually, but right now it is a setback that we have come down to 7.
Right now it is a setback. We have discussed a couple of reasons why that lack is there. But one, you said once we have an AI play, there could be better chances of an improvement. But apart from that, when do you think investors can expect money to return to Indian markets? And what is going to be that big trigger or turnaround for that? Is it going to be just the pure AI play, or are there going to be more factors?
When your earnings growth justify your valuations, or the market falls down even further from here. For 2 years, we have given no returns now. So we are an underperforming market. If Normally what we see are two or three things happen. One, when the rupee stabilizes, maybe it has happened on Friday. We saw rupee coming down under 95 rupees to the dollar from earlier levels of 97 even earlier in the month. So there is a recovery in the rupee. Second, when our growth stalls, that's the point when the markets start to turn. That has not happened. We are still growing very fast and growing well. So I would not call a bottom to the Indian market yet. And the problem is we have underperformed for 2 years. The world has done very well. The world is sitting somewhere near to 2000 kind of levels, where then the market did not perform for 10 years because of the huge run up that happened in the last 5 years going into 2000. We might be reaching a stage like that, maybe this year or next year, where a global market crash comes in. Our problem is we didn't rise when the market went up on AI momentum. And when the global markets fall, we will get our fair share of selling. So I don't foresee the FIs returning too soon. And I see a very big issue for us in the overvalued US markets, overvalued AI plays that is happening. You look at the SpaceX IPO, which is coming out, it's 94 times sales. 94 times sales. Normally, you would have 3 times, 4 times sale as the IPO cost. He's bringing it at 94 times sale. So are we at the peak of this AI trade, which is really making everybody rush and invest money? If that corrects end of this year or sometime next year, we will also face the issue. As we faced in 2000 to 2003, our markets went practically nowhere. And then we just tripled in the course of the next 4 years. So I'm a little wary now, given where the global markets are, that could pull us down as well, even though we have not participated in the way up. But on the way down, we will participate if there's a global sell-off.
Okay. Now, if there is a global sell-off, Indian markets could also participate. Like you're pointing out, the 2000s period where we saw the sell-off correction happening. If that happens now, how long do you think that period could last, and when could be a turnaround?
Yeah, for India, it will be shorter because we have not participated on the way up. So it will be more the momentum money coming out or people having losses elsewhere. They will book some losses from India because we are a fairly liquid market. As you said, in 5 months, we have given about $24, $26 billion, and the market has held up value. So we will see an initial sell-off. And then we should recover faster than the rest of the world because we still remain a very diversified economy, a very domestic economy, not so export dependent. The contagion will come in via the FPI selling. They will take out money, but we will recover faster. So very difficult to say how long it would take, but I would hazard that we will be faster than the rest of the world. Maybe in a year, we would have come back to the point at which the global crash starts.
Understood. So we'll wait and see how the global market reacts and how India reacts further. But, that's about the institutional investors picture. Let's talk about a more retail side of it. many people feel that their salaries and savings, they aren't keeping pace with inflation. Then there's rising fuel prices. So when do you think real income start improving again for the common man?
Yeah, it's a very valid point you're making. Inflation has been faster than the wage growth. And what has happened is, even though corporate profits have gone up, the companies have not really increased their employee cost. So that is showing at an economy-wide, we are not seeing salaries rise as fast as the inflation or as far as our growth should lead to. So we have an issue there. How does it self-correct? If there is massive growth and there is a lack of employees, lack of labor, as we are seeing in, say, construction projects, you're not getting enough labor. Real estate projects, very hard factory work, you're not seeing enough Indian labor coming in. Agriculture, you're not seeing the seasonal labor coming in because of the welfare schemes the governments are giving, both at center and state. The labor is staying at home rather than coming in and doing these backbreaking work. So those level of remuneration has to increase. The government has a safety net. Nobody's dying of hunger, at least, with 80 crore Indians being given monthly food rations. That is helping a lot in creating a safety net. But wages have not gone up. It will come when there is very strong earnings growth and very strong economic growth, and shortage of labor will cause that. Right now, unfortunately, with the amount of automation, with the impact of AI,
Right.
digitization, what's happening is human labor is being substituted
Right.
by digital labor.
Right. You made a very good point that remuneration must be at par with the corporate profits that are rising. So at this point in time, for the common person, what would you say is a bigger risk? A falling stock market, high inflation, or slowing job growth?
All three, but if you have to rank it, stock market is very low because Indians' participation in the stock market is not very high. So that will not have that big an impact. Yes, on the very affluent classes, they have a higher allocation in stock markets. But I would say job growth is the biggest issue. We are seeing that in sectors like IT and more sectors we are seeing jobless growth coming in because of the automation. So it's not easy. It's a global phenomena. The world just has too many human beings at 8 billion for the earth to support. And there are no jobs globally. So Indians have to find their niche, have to
Okay.
train, and careers will be more doing your own jobs, doing your own businesses rather than working for a company for 30 years. That's the big change that's coming.
Right. Mr. Bagga, you said that retail participation, domestic participation in stock markets, it's still very low. But over the years, it has been improving. Domestic investors, especially youngsters, they've been buying while foreign investors are exiting Indian market. Do you think can that SIP money alone keep markets stable for a longer time?
Yes, it will. So overall, on aggregate basis, yes, we are big. But as a percentage of household savings, 28% is sitting in gold, for example. Hardly 4% is there in the stock market. So that's why I said it. On an aggregate basis, what we see is, these 5 crore SIPs or 7 crore SIPs, and say everybody has 2 or 3 SIPs. In the end, that investing class is probably 1 crore or 2 crores at the most out of 140 crores. So otherwise, the politicians would have been paying us more, heed and not taxing us so foolishly, where it's killed the golden goose itself. That itself shows the investing class as a political class doesn't matter. So obviously, the numbers are not there. And even if you look at the household savings, 50% is in physical assets. Out of the 50% financial assets, the equity is very small still. On an aggregate basis, because we are a huge economy of four
Right.
and a half trillion, it means something. But as a portion, it doesn't mean much.
Right. Thank you, Mr. Bagga, for joining me today and helping us understand the current situation. We'll keep tracking it with you as it unfolds. On that note, I'll let you go.
Thank you so much.
That's right. So the big question now isn't just when markets recover. It's when growth, jobs, and higher income start reaching ordinary households again. Thank you for joining me on WION.